Hello, hi everyone. Good morning, everyone, and good afternoon, good evening, wherever from you are joining. Today we are going to see the impact, risk, and opportunity related module, and it's module 10 out of module 39. I'm just sharing my screen quickly, and let me know when you can see my screen so that I can understand. I hope now you can see my screen. If you can just send me the emoji. Okay, thank you for the confirming. So, welcome back, everyone. If this is your first time joining us, a very warm welcome to End-to-End ESG and Climate Reporting Series. I'm really glad you are here. So, we are now at Module 10 out of 39, and we are reached what I genuinely believe is one of the most important module in this entire series. So, today we are going to talking about the impact, risk, opportunity assessment and management that stands for the IRO assessment. And also, before we continue, I will be sharing all the templates, calculation spreadsheet, and supporting resources inside our ESG and climate analysis group on Instagram. So if you have not joined yet, if you are new for this particular channel, please make sure you do so now. I'm posting the group link in the chat with Instagram page and the group. So this is where I will upload the Excel calculator, practice sheet, updates, upcoming modules, and additional implementations tools as well. So if you don't want to miss any templates or future sessions updates, follow on Instagram and on the YouTube as well. So I will also use this group to share reminders and new modules announcements. So I'm just quickly share. So if you have not joined, I'm just pin the particular comment and you can have a look on that side. Okay, so this is the module 10, and we already have done module 1 to 9, which is a great achievement. So for that, please like, comment and subscribe to this channel. Your support gives me the motivation to keep creating more detailed content on climate risk, ESG and sustainability. So this videos take significant times and our effort to develop, so your support is greatly appreciated. If you can just like to the video right now if possible, and subscribe the channels and join if you want. And also lots of other peoples are joining through the Zoom and Google Meet, so I would request you can go and check this channel as well. So you will notice that the three circle on this particular side, impact, risk and opportunity. So these three concepts sit right at the heart of both ESRS framework that we already showed in module 1 to 6, which governs the sustainability reporting under the EU's corporate sustainability reporting directives, and IFRS sustainability disclosure standards from the ISSB. So if you can master these three concepts and the process around them, honestly everything else in ESG reporting start to fall into the place. So now before we dive into, let me just orient you what we are covering today. So this module is structured into various types of working requirements, each about for a particular time that we are going to spend on the each and every slide. So the total runtime around will be 1 hour, and I will be encourage you to take notes and whatever that your questions you have during the session. We'll have a question answer session. So we will start it right now, and we are going to lay the conceptual requirement. So the second slide, which is showing you the module overview. Here's the hours is just for the opportunities related stuff. So here we are going to see learning outcome for this particular module, because I want you to have a clear picture what you will be able to do by end of the day today. So by the time you complete all the learning slides, first identify sustainability related impact, risk and opportunity systematically. We will see that, and I want you to emphasize that word systematically. We are not talking about brainstorming on a whiteboard. We are talking about a repeatable evidence-based process. Second, assess the prioritize those IROs using a structure criteria. So we have very specific scoring methodology for impacts and a different set of criteria for risk and opportunity. So we will walk through both in details, and will have a Excel analysis tool as well. Third, integrate the IRO management into your existing enterprise risk management process. One of the biggest mistake organizations make is running sustainability risk management in a silo manner. So completely separate from their mainstream risk function. We will show you how to fix that. And fourth one is link IROs to your strategy, your business model, and your financial planning. So this is increasingly what investors expect, and it's what both IFRS and ESRS explicitly require. And fifth one is disclosure IRO informations in accordance with the regulatory requirements. We will get into the specific disclosure requirements under ESRS 2, particularly IRO 1 and SBM 3. SBM 1 and 2 and 3 we already shown in module 1 to 6, as well as in technical methodology that what it stands for, as well as what IFRS S1 and S2 that require. So now on the left panel on this slide you can see the 5 video structures, which is just for the overview. We will cover all the stuffs in today's video only. So think of it as a journey. We start with the concept, move into the identifications and assessment, then management, and finish with disclosures and monitoring. So each video builds on the previous one. So if you already completed module 9 on materiality assessment, you will find that a lot of what we cover today. So feels like a natural continuations. If you have not, don't worry, I will reference the key concept as we go, but I do recommend going back to the module 9 and also the module 1 to 8 if you have not already. So let's go to the three components of IRO. So, right, this is the most conceptually important slide in the entire module. So we have the three components of IRO, that is impact, risk, and opportunities. And I want to spend a real time here because many organizations confuse this, and that confusion creates a problems downstream where you are doing your assessment and your disclosures. So first is the impact, that is inside out perspective. So let's start with the impacts. The ESRS definition is impacts are effects, and positive or negative, which can be on people or the environment or the planet. So that result from your organization's activities and business relationship. So the key phrase here is inside out. So your organization sits at the center, and impacts are the waves that ripple outward from your activities. So out to people, out to communities, out to ecosystems. So that is the impacts that are going to happen. Think about a manufacturing company, for example, and when that factory runs, it produces carbon emissions, as we already know. So those emissions go into the atmosphere first, and that is the impact that we are going to take as a account. So not on the company's financial positions, on the actual physical world. That's what we mean by inside out. Other example I would give you, your supply chain might involve a labor practice that affect workers in ways that violate their rights. So your operation might discharge water that affects downstream communities. So your products might contain a chemical that harm consumer health. So all of these are the impacts, and for that it is very important to understand the inside out perspective through your organizations, through your product, through your service. Now, and this is a really important. So impacts can be positive as well as a negative. So if you run a community skill training program, that has a positive impact on people because it's a social impact assessment program you are already running. So if you restore a wetland, part of the environment program, that is also positive impact on the ecosystem. So ESRS require you to consider the both. What are the positive impact of your products and service, and what are the negative impacts that can be helpful to understand better. And impacts can be actual, they are currently happening right now, or they can be potential. They could happen based on your activities and business models. So you need to understand how it's work. You need to assess both types. So that is a very important for the impacts. Second is the risk, in yellow module. So you can see that uh, This is a completely different concept, different perspective, different directions, and different audience in mind for the risk. So risk, it's outside in perspective. So the IFRS S1 definition is sustainability related risk are sustainability matters that could reasonably be expected to have a negative effect on the entity's cash flow and access to the finance or cost of capital over the short, medium, and long term. So that is the IFRS S1 definitions under the SSB. So notice the direction has flipped. We are not talking about your effect on the world. We are asking what is the world doing back to your organizations. So this is outside in, and the sustainability conditions and trends in the external environment flow inwards and affect your enterprise value. So, for example, let's use the same carbon example. Earlier, I said carbon emissions are an impact. Now, flip it. If a government introduce a carbon pricing mechanism, which is a carbon intensity programs in India, Switzerland, and lots of other jurisdictions, now they are introducing a carbon pricing mechanism, and some of the developed country already have this carbon tax mechanism. So, say $100 per ton of CO2, that external policy development flows inward and hits your cost base or your product. So European Union has introduced the CBAM. So that is the risk that your products and service has. So that's a transitions risk. Uh, or think about physical climate risk. So rising the sea levels and increase of flooding, that's a global phenomenon. But if one of your manufacturing plant sits on floodplain, that external physical change translate into the specific financial risk for your business, asset impairment, operational disruptions, that is covers the insurance cost. So all the things are part of the risk. And the third one is the opportunity. Uh, so now opportunity, these are the flip side of risk. So where risk or sustainability matters that could negatively affect your enterprise value. So opportunity or sustainability matters that could positively affect your financial positions, performance, and the cash flow. So think about the renewable energy transitions, for example. So for a company that relies heavily on the fossil fuels and because of the wars, it's very great opportunity for the renewable energy market that you can go with the non-fossil fuel because of the energy and gas prices and the crude oil prices are going up. So the transition is a risk, but a company that's been investing in renewable energy infrastructure, that same transition become a massive commercial opportunity, I mentioned. So lower operating cost, access to the green finance, premium pricing in market that reward the sustainability leadership. So that is the very good opportunity that can any company or any individuals can be done. So the reason I am spending so much time on this particular definition is that your management response and your disclosure so will be very different depending on whether you are dealing with an impact, risk, or opportunity. I hope you understand the IRO, which is impact, risk, and opportunity. Now we will move into the assessing the impacts that covers the four key dimension and which is very important. So let me make one final critical point before we move into the uh, things. So under the ESRS, the European framework, you have to assess what's called as a double materiality. So this means impact materiality, financial materiality. The same topics can be material from both perspective. And under IFRS also, you only have to assess the financial materiality. But if you are doing ESRS anyway, you are automatically meeting the IFRS bar and more as well. So overall, my advice is if you are a CSRD scope company, do the full double materiality assessment and go and check out the module 9 for how to assess the impacts. So now that we understand that impact, risk, and opportunity, we need to talk about how to assess them. So we will start with the impact because they have the distinct set of assessment criteria. So that's specific to ESRS. So first one dimension is the scale. So scale refers to how severe the impact is. For negative impact, you are asking how grave is the harm. At the top end of the scale, which can be the score of 5 or maybe high for out of 10. So you have impact that violate fundamental human rights or that cause that irreversible of environmental damage. So think of child labor or extinction of species. At the bottom, that can be score of 1. So you have a negligible, barely measurable effects. So for positive impact, scale flips to the mean, how beneficial or transformative the effect is. So a score of 5 would be the represent truly systematic positive change and restoring the entire ecosystems or lifting the thousand of people out of the poverty. So that is the scale, from 1 to 5, 5 to 1. You have to assess those kind of stuff. We will see in the details in the Excel analysis. The dimension 2, which is a scope. So scope is about a breadth, how many people or how much of the environment is affected. This is a quantitative wherever possible. So at score 5, for example, more than 10,000 people or more than 100 square kilometers of ecosystem are available. And at score 1, fewer than the 10 people or tiny localized area is available for that particular stuff. So this dimension is particularly important for human rights impacts, and impact that affects a single work is very serious. So, but impact that affects 50,000 workers across a supply chain is categorically different in terms of disclosure priority. So that is the scope. Dimension 3, which is irremediable character. So this is the dimension that distinguishes ESRS from most traditional risk frameworks, and it's one of the five really powerful. So a score of 5 means that impact is completely irreversible. That can be the date, permanent disability, species extinction, etc. There is a no remedies for the score 5. So once it happened, it's done, it's gone. A score of 1 means the impact is fully reversible and with reasonable efforts. So that is very important. Dimension 4 is likelihood. So for potential impact, those that have not occurred yet, you need to assess likelihood. So how probable is it is that is impact will actually occur given your current activity. Score of 5 means it's essentially certain, about 95% probability, perhaps because it's already happening. And score 1 means it's a remote below the 5%. So for actual impact, those already occurring, likelihood is by definition certain. So you focus more than the first three dimensions. So putting it all together, the overall score, how do you combine this four dimension into the single overall score, which is called as a normalizations? So there are three recognized approach. The simplest is to use the highest individual score. If any dimension scores a 5, the impact is treated as a high priority regardless of any other stuff. So general rule is if the overall score is about 3 on a 5-point scale, you would treat the impact as a potential material and subject it to the further assessment. So below the threshold, you can document it and set it aside unless a circumstance change. So it depends on your product and service. So this is the overall assessment requirements for any kind of impacts, and this four key dimension we will see in the Excel sheets that how it's work. I'm just explaining the dimensions, how it's work, what are the definitions, what it's available, what are the meaning of each and every word. So assessing risk and opportunity, that also cover the three dimension, which is again risk categories, and covers through the magnitude, likelihood, and the time horizon. So here you can see that dimension 1, which is a magnitude of financial impact. So this is the core questions: how much money is at stake through the any kind of impacts are coming up. So ideally you want to quantify this first. What is the potential impact on your revenue, your EBITDA, your asset values, or your cost base? The scoring guidance is a score of 5 means the financial effect could exceed 10% of your annual revenue EBITDA, and that is a major potential existing risk or transformative opportunity. A score of 1 means the effect is less than a tenth of percentage and essentially rounding a error territory. So now in practice, many organizations struggle to quantify this financial effect at this stage. So if you are part of this series and if you are learning this IRO assessment, you will be a pro in this, and especially for the longer horizon risk. So you can start with qualitative scoring first if you cannot do a quantitative, like catastrophic, major, moderate, minor, negligible, those kind of words. But I would strongly encourage you to push towards the quantifications over the time period. And the framework are moving in the direction of IFRS S1 as well as the ESRS. So one useful technique is scenario-based estimations. So under the carbon price of 100 per ton, or our cost base increased by approximately 5 million per year, for example, so which represent almost 2.5% of annual revenue. That kind of back of the envelope estimate is far better than leaving it purely qualitative. So that is the dimension of magnitude of financial impact. Then you can see the left side of risk category. Worth to know that on the left side of this slide, you can see the four main risk category. So physical risk are those driven by actual physical changes in the climate or natural environment. Acute physical risk are the event driven, which can be the floods, wildfires, storms. Chronic physical risk, that can be the gradual increase. So sea level rise, long term temperature, increasing water stress, and other stuff. Transition risk are those arising from the shift to a low carbon economy. So policy and legal risk include carbon pricing, emissions regulations, deforestation law. Those kind of stuff is part of the transition risk. Technology risk is also part of the transition risk. So here social risk is also part of the overall risk category. And also the governance risk, which can be include corruption, inadequate board oversight, transparency failures, etc. Dimension two is the likelihood. So likelihood for risk and opportunity work similarly to likelihood for the impact. So you are assessing a probability on 5-point scale from remote to almost certain. So that is covers the likelihood. The third dimension is a time horizon. Both ESRS and IFRS ask you to classify risk and opportunity by the time horizon, which can be the short term, means less than 1 year, medium term 1 to 5 years, and long term beyond 5 years. So here you can notice that in the scoring guidance, short-term risk actually score high. So a score of 3 versus 1. This is because a near-term risk requirements and more immediate management attention. So have more direct impact on your current strategy planning cycle is more requirements to understand how it's work. So long-term risk is very serious, but you have more time to adaptations. So this is the part of the overall dimension of any risk assessment things. Now we will see the key sources that how the IRO definitions can be done through various key sources. So first one is a materiality assessment that is very evident in module 9. We already saw seen that requirements. Second is the enterprise risk register. So your existing enterprise risk register almost certainly contain a risk with sustainability dimensions, even if they are not labeled as such. So you have to check and go through those dimensions. Then stakeholder feedback. So your stakeholders like employees, customer, community, investors, NGOs are often aware of impacts and risk before your internal teams are. So you have to understand the stakeholder feedback. The fourth one is benchmark. So SASB standards now published under the IFRS Foundations gives you a 77 industry specific standards and identify the sustainability topics most likely to be material for each sector. So if you have not looked at your sector SASB standards, I would encourage you to do that. And it's a excellent starting point, and it means you are not starting with a blank page. Source 5 can be the regulatory horizon scanning. So emerging regulation is one of the most important source of transition risk. So the EU deforestations regulations, for example, CBAM, human rights due diligence law, plastics taxes. These are the all various stages of implementations or development. So if a regulation is coming that will affect your business model, that's transition risk that needs to be in your IRA register now. So that are the source 5. Source 6 is science based assessment, which is a very important, and I like a very much. The IPCC's climate reports, which is a biodiversity assessment, IE energy. This gives you the physical and the scientific basis for understanding what the world is going to look like over the 10, 20, and 30 years. So they are practically important for identify a long horizon physical risk and understanding which transitions pathway are most likely. So overall, it is very important to understand how it's work for those kind of stuff. Now we will move into the section 3 of overall assessment and management. So mapping the IROs across your value chain is very important and very critical. So we are now moving from the conceptual and assessment dimension into the two important practical topics, which is a value chain of mapping and the connecting your impact, risk, and opportunity to your financial statement. So both of these are required by ESRS and IFRS S1. Let me start with the questions. When you think about your organization's environment and social impacts, where do you tend to look first? So most people instinctively look at their own operations, their factories, their office, their fleet, and their understable whatever that instinct are. So that's where you have direct control. So I would like to stop here and take some questions. And if you have any particular requirements on this IRO, just let me know. Okay, great. So the value chain stages on this slide, you can see the full value chain that broken into the five stages. First one is upstream, tier one. I can just zoom out so you can see better if you, yeah. Tier 1 suppliers own operation downstream and end of the life. Upstream covers that raw material extraction and processing, and the suppliers beyond you direct relationship. So what we call tier 2 and beyond, this is part of the upstream things. This is often where the most significant social and environmental impacts are concentrated. So tier 1 supplier are uh, your direct business relationship. So the manufacturing and the processors you have direct contacts with, you have much higher leverage here because you are paying them directly. Then own manufacturing, downstream that covers how your product gets the customers, distribution, retail, and etc. And end of life covers what happens to the product when consumed are done with them. Landfill, maybe recycling, maybe incineration. This is increasingly a site of both regulatory risk. Then the leverage and control. An important nuisance here is the value chain approach is not saying you are responsible for every impact across the entire chain. It's saying you need to understand them and exercise appropriate leverage. So these are the overall upstream, tier one, own operation, downstream, and end of life value chain. Now, to map this out, you have to understand the requirements of regulatory from ESRS versus IFRS. So here, quickly, I am showing you the financial linkage requirements. So now let's talk about something that trips up a lot of sustainability teams, connecting IROs to financial statements. So both the IFRS S1 and ESRS require this. They want sustainability disclosure to be connected to your financial reporting. So at and it's make very sense that if sustainability risk is genuinely material, it should show up somewhere in how you report your financial positions. So starting with the revenue, IROs can affect your top line in multiple ways. Market demand shapes. If consumers increasingly prefer sustainable products and you are not offering them, that's a revenue risk. Similarly, if you are ahead of the curve on sustainable product development, that's a revenue opportunity. Cost, on the cost side, carbon pricing is the most discussed one. So if a carbon price is introduced in your jurisdictions and you have significant scope 1 and scope 2 emissions, your operating cost go up. And the other flip side of the resource efficiency opportunity, which is investing in energy efficiency, water recycling, or waste reduction, those kind of opportunity you have. uh, for assets, asset level impacts are particularly important for capital intensive industry. So physical climate risk can render asset unusable. So on the positive side, investment in climate resilience, renewable energy, and sustainable infrastructure are new asset category that create a long-term value. And the liability is provision of environmental remediations, that contingents of liability from regulatory enforcement actions. So hundreds of millions of dollars related to that historical environmental contaminations is part of the liability. And then equity and access to the finance, which is a growing body of evidence that strong sustainability performance is required. So the practical challenge is that sustainability teams often produce the IRO register without talking to their finance team, and the finance team prepare their financial statements without talking to the sustainability teams. So bridging it the gap, having a shared IRO to the financial statement mapping exercise is one of the highest value things you can do to improve your quality of your sustainability reporting. So here we understand overall requirement. Now we will see the management and integration part, that how IRO management strategies can be done. So quickly we will see the negative positive impact. For the negative impacts, the management hierarchy goes that seize, prevent, mitigate, remediate. Those kind of requirement is there. So this sequences matter. It's not arbitrary. So the highest priority is to stop the causing the harm altogether. If there is an activity in your value chain that cause severe harm that cannot be adequately mitigated, the right response is to cease that activity and exist the particular relationship. Then managing the risk. So for risk, the framework mirrors a mainstream risk management that can be avoid, reduce, transfer, or accept. So avoidance means eliminating your exposure entirely, existing a high risk market, and it can be done a very specific actions. Then pursuing the opportunity. So for opportunity, the framing shift completely. You are not managing downside, you are maximizing your upside, enhance your positive impacts, and scale the programs that are already delivering your pursuit. Now we will move into the different slide for the IRO to financial statement, that is mapping in practice. So connections of IRO to the financial statement, as I mentioned, the revenue, cost, assets, and liability that can be helpful to understand the market demands, and similarly, cost can help you to understand the carbon pricing. So that is both required by IFRS S1 and IFRS ESRS as well. So that is part of the overall financial statement. Now, for ESRS, that disclosure is very important. So, what ESRS2 actually requirements? So, let's get specific about the ESRS2 actually requires you to disclose. So, there are two key disclosures requirement: IRO 1 and SBM 3. So, IRO 1 requires you to describe you a process for identifying and assessing material IROs, not just to list your IROs. So, describe the process itself. That means your disclosures needs to cover what methodology you used, what sources of informations you consulted, how you consider your value chain, how you engage your stakeholders, all types of stuff. It's required to describe your process under the IRO 1. In SBM3, disclose your material IROs. So SBM3 requires to actually disclose your material IROs you have identified. For each one, you need to describe the nature and type of the IRO, the time horizon, short, medium, or long term, the value chain stage where it arises. So the current and anticipated effects on your strategy and business model is the financial effects. So that is the part of the SBM3. And similarly, you should integrate all stuff through the enterprise risk management ERM. You can follow the COSO framework as well as the ISO framework. So IRO management that can be maps onto the COSO ERM framework, one of the most widely used enterprise risk management framework globally, and ISO 31000 connection. So for organization using ISO at their risk management standard, the connection is equally clear. So that can be helpful to understand what kind of IRO assessment can be done for overall enterprise risk management. That can be also covers the financial risk as well. So that is integrations of enterprise risk management. Now we will see the disclosures, the particular case study, the real example, not in a theoretical manner, that how can any company can monitor and review. So here we have to continue the exercise of continuation cycles that look at the cycle on the left side, that identify, assess, prioritize, manage, disclose, and then monitor, and then back to the identify. This is the heartbeat of the good IRO management. And for that, you will require a key risk indicators that called as a KRIs, and on that can be the ongoing basis. So you are monitoring regulatory development, you are feeding incidents and near misses back into your risk assessment. So you are listening to your stakeholder concern as they arise. And KPIs for the IRO management is also very important. So you can develop a monitoring continuously, quarterly, annually, ad hoc based, that kind of stuff. Now we will see the case study of large European retailer, that part of the CSRD scope. So putting all together a worked example that I have considered here. So now let's see how everything we have covered and we played in a real world scenario. So I want to walk you through this case study. A large European retailer subject to the CSRD. The company profile is 5 billion in revenue, 200 stores across Europe, 10,000 direct employees, and a global supply chain covering that apparel, electronics, home goods, exactly the kind of company that's in scope of CSRD from the 2024 financial year. So the starting point is for there were 47 potential IROs. So when this company did their initial IRO identification using the six source framework we covered earlier, they came up with 47 potential IRO. Let me emphasize 47, not 3, not 10, 47. So that initial long list came from their materiality assessment outputs, their enterprise risk register, stakeholder engagement from employees, customers, investors, and NGOs. Their sectors, SASP standards, regulatory horizons, came focused on EU policy and physical climate screening. So after applying this all assessment criteria, scoring each potential IRO on the relevant dimension, they narrow down the 12 high priority IROs and 15 medium priorities IROs requiring disclosure. The rest 20 items were documented and set aside pending monitoring. So you can see those kind of overall company profile, IRO descriptions, and overall high, medium, and low level IRO requirement. So walking through the priority IRO is uh, uh, let me walk you through the table on these slides. The first IRO, that forced labor in their apparel supply chain. So this is the classified as an impact. It's the effect of their business relationships on worker. So impact score is 3.75, making it a high priority. The scale is 5. So forced labor is fundamental right violation. Scope is 3, that is estimated 200 worker potentially at risk in tier 2 suppliers. And irremediability is 4. The developmental effects on people subject to forced labor can be permanent. And the likelihood is 3. There is a limited visibility beyond the tier 1, but the risk is very real. And management response is the supplier mapping, enhance the audits, and worker voice mechanism that they have developed. That can be the hotline and survey. So they built those kind of stuff for the budget of 2 million per year. So this is a high resource, high priority response to a severe potential impact. So that is covers the force label in apparel supply chain. The second one is customer demand for sustainable products. So this is an opportunity. You have to understand that customer demand for sustainable products, which is an opportunity to develop and to enhance your operation very well. So that is part of the outside in. So financial material. So score of 3.33 is the high priority, and magnitude is the 4. The company estimate this represent of 250 to 500 million revenue opportunity within 3 years. That can be likelihood of 4. So the market trend is very clear and established. So time horizon is medium term. Management response is expanding the sustainable product line to 25% range by 2026. Eco labeling programs, supplier partnerships, everything they have done, and they do require a capital investment of 10 million. So the company is explicitly investing to capture this opportunity very well. So that is part of the overall IRO of the opportunity. The third one is customer demand for sustainable products. So this is an opportunity. You have to understand that customer demand for sustainable products, which is a opportunity to develop and to enhance your operation very well. So that is part of the outside in. So financial material. So score of 3.33 is the high priority, and magnitude is the 4. The company estimate this represent of 250 to 500 million revenue opportunity within 3 years. That can be likelihood of 4. So the market trend is very clear and established. So time horizon is medium term. Third IRO is the carbon pricing on scope 3 emissions. So here the risk score of 2.67, medium priority. Why not high? Because while the magnitude is moderate, around 25 to 125 million potential cost increase, the supplier engagement program, reduction target, transitions plan, those kind of management response they already have. So this one does not need the same immediate resource intensity as the first two. And the fourth one is the flooding risk to distribution centers. So this is the physical climate risk with score of 3.1, which is again a higher priority. Why high? Because even through the likelihood is medium term, the magnitude is potential very large, up to 50 million in asset value at risk. So management response, physical risk assessment, flood barriers, backup logistic plan, and the capital investment of 5 million requirements. And the fifth one, that is EU plastic packaging regulations. So the score is 2.9, medium priority, and likely to be enhanced, but with some timing uncertainty. And the financial impact is very manageable. So management response is like a packaging, the redesign program or alternative material sourcing, those kind of stuff can be done. So what I want you to take from this case study is the specifically the IRO is not a vague sustainability strategy talk. It's here is the IRO, and here is the score. Here is why, and you can see the what we are doing about it for the particular company. Here is how much money we are spending as a part of the capital investment to capture the opportunity. So that level of specifically is what investors want and what regulators require and what genuinely good management looks like. So this is the case study which is very important. That is, I have gave a few time minutes for this particular case study. So then we will move into the common challenges. So I quickly go through the common challenges. Too many of potential IROs, then lack of quantitative data, then value chain complexity, silos teams, as I mentioned earlier, that finance, legal, sustainability risk, and operation teams often work in separate silos. Assurance readiness, limited and eventually reasonable assurance is required, but the documentation, your methodology, maintaining and evidence is not available and ready. So that is the challenge. So these are the challenges that we need to understand. So overall, the key takeaway and your action plan is we have covered together. And let me crystallize that. One, that IRO are the foundation. Two, that is systematic identification is non-negotiable. Use all six sources. Structure assessment enable prioritize. So without structure criteria, scale, scope, irremediability, likelihood for impacts is not worth it to do IRO management. Four, the value chain matters enormously, and for most of the organizations, the most significant impacts and the risk lie outside direct operation. And fifth one, financial linkage is mandatory. So connect every material IRO to its effect on revenue, cost, assets, or liability. So this bridge gap between the sustainability reporting and the financial reporting. Sixth is integrating, don't separate. Seven, this disclosure is substantial for ESRS 2 and IFRS 1. Eight is monitoring should be continuous. So IRO is not a one-time exercise. Build the onto your governance calendar and your team's work plan. So here I'm stop, and if you have any particular questions, we will have a questions answer session now, and then we will move into the Excel analysis tool, and I am going to share one of the good announcement as well, which easier and makes your life very easier. So if you have any questions for the IRO that we already show, uh, m- before move into the Excel analysis template, you can ask the questions. Just write in the chat box. Zoom people can write on the chat, and I will try to answer on that. So the how to calculate the IRO. assessment, we are going to see the Excel sheet analysis. As I mentioned, you have to score based on your stakeholder requirements, you have to score based on your likelihood, you have to score based on your financial analysis. So that can be done through the Excel template, or maybe you can utilize the different tools. Okay, great. We can move to the Excel analysis tool now. I'm just sharing my screen. Just let me know when you can see my screen. So I will start. Okay. So as we see in the module 9, I have created the double materiality Excel sheet. Similarly, we have created for the IRO assessment and management toolkit for everyone who are part of the ESG sustainability and the climate professional. I'm just sharing the double materiality tool link as well. If you want to explore, you can explore. If you missed the last sessions, lots of people has already started to explore those kind of double materiality assessment tool. uh, so I'm just sharing in the chat box the DMA tool, which is part of the module 8. So if you want to explore and requirements. So yeah, in IRO assessment, you can see the overall sheet for the sheet one, that instruction full with color coding key, workbook structure, guide, and 6 steps that quick start your process with clear instruction for each sheet. So here you can see that instruction, IRO long list, impact assessment, risk and opportunity assessment, priority matrix, value chain map, management tracker, and disclosure register. So all the stuff that is part of the whole toolkit. And purpose, you can see the overall identifications, overall map, and other stuff. And the key features of each and every state sheets are mentioned here. That is part of the introduction. These are the legends that how the high priority, critical, medium, high priority, medium, low, and risk captures. These are the steps that how this toolkit of Excel sheets can be utilized, so that you can quick start with the 6 steps process as I mentioned in the presentation. So step 1, that can be part of the sheet 2, step 2, that can be part of the sheet 3, step 3, that can be part of the sheet 4. So I mapped out all the stuffs, and in descriptions you can see the details out how it's calculated and how it's worked. So through this whole toolkit, you can understand through the instructions and how it's work on that side. The second sheet is the IRO long list. So in the second sheets, you can understand the IRO long list, 25 preloaded sample of IROs, that IRO 001 to IRO 00025. So across all ESG topic with source tracking from S1 to S6, full classifications that can be dropped down. So initial screening columns, and you can see that IRO descriptions, IRO IDs from 1 to 25. Source code is S1, S2, S5. You can also change based on the requirement. Source details, reference, type of impact, risk, and opportunity. ESG topic theme, you can change positive or not, negative as per your products. What are the value chain and on operations, on ops? What are the pass initial screening or not? And then overall workflow. And you can also mention the next steps for the particular whole value chain. So it is very important to understand the each and every details of the source code. Source code, it means the 6 steps that are very important to understand which steps are going on. Then third sheet is the impact assessment. Again, is very important sheet. So impact assessment, 13 impact scored, 13 impact scored across all four ESRS dimension, that scale, scope, intermediability, likelihood. So three auto-calculated scores, that highest dimension, weighted average, and the geometric mean. So priority and materiality labels are formula driven. So here you can see the scale that is based on the score, scope, what are the scope of that particular stuff, amenity and likelihood. So those kind of stuff, this is there, and you can read the scoring guidance in the instruction as well. Here you can see uh, the normal requirement of the calculating the IRO reference, that we have calculated uh, overall scope of the requirement, that IRO ID descriptions, get important positive, negative, and other stuff, which is a very important stuff that already have evidence notes, assessment outcomes, and other stuff. So which is very important to understand that how IRO reference can be given, what are the four dimension scoring for each calculating scores, and what are the evidence notes, which is helpful for during your assurance process and assessment outcome. Then we do have a risk and opportunity assessment, which is a part of the important priority matrix of all 10, 24 IROs, that consolidated and ranked in one view from high to low. So portfolio summary, statistics, auto update, and materiality confirmations column, management approach, ESRS approach. So those kind of stuff that already given into the details analysis of arrow descriptions, time horizon. You can see the priority material and assessor's name as well. So that is very important for the risk and opportunity assessment. Similarly, the priority metrics are also there. So you can have a look on that, how the priority matrix is working on that site, as we see that material thresholds for the each and every requirement. So here you can see the material impacts of particular requirements, and how priority matrix for the high to low is helpful, and ESRS and IFRS reference and board awareness track. So how it's work on that particular site, then on obtain of sign off. Uh, then value chain mapping, which is again, it's very important. From whole value chain map, all the materials are mapped across the seven value chain stage, raw materials to the end of the life, and leveraging scoring from 1 to 5 with color coded rational. So data availability and gap analysis columns can be shown those whole type of requirements. So here you can see the leverage guidance, and the overall, it's showing you the descriptions, primary value chain stage, scope 3 categories, and leveraging rationals on that sites, and management approach on that side. So that is very important to understand the value chain mapping for the IRO assessment. Then management tracker, that how it's work. I have show you the one of the case studies. So similar case studies that I have put into this here as well. So you can see the overall mark of the management tracker for 12 priority areas with full policies, actions, resource, capex, opex, FTE, KPIs also with baseline target, current values, progress, a percentage, all this stuff, and including the rack status. So fits directly into the ESRS of SBM3 disclosure, and you will have your report ready. And the final one is the disclosure register. So disclosure register of ESRS2 requirements of IRO1, that is a process question. So 7 items, fill in the fields, plus full SBM3 narrative disclosure for 4 priority IROs with current anticipated financial effect, and strategy linkage and assurance status. So those kind of stuff is very important to understand that how it's work, and how you can add your descriptions for each and every IRO, for each and every requirement based on your organization specific approach. So this is the overall sheet of 8 sheets that we already have. So you can download through the link that I'm going to provide you, and you can model your resource based on your products, review your existing enterprise risk register for sustainability dimension, and identify who is in your organizations needs to be part of your cross-functional IRO working groups. And those kind of initial IRO identification using the six source framework, build your long list, map your value chain, begin your stakeholder engagement, and then next month, next quarter, complete the whole assessment, prioritize, begin mapping to financial statement, and develop a management strategy for your top priority IROs. So those kind of stuff is very important for the IRO assessment tool, and you can have easily access and download the Excel sheets. If you can click on this link, and you can go through and register the all the process, then you will get the access of the IRO Excel sheet template. So I'm just pin this IRO assessment tool. So if you want to access this whole sheet analysis, you can go and watch that particular requirement. So we have already seen this all types of stuff and what's coming in module 11. So we are going to take the climate related IROs you have identified already today and subject them to scenario analysis. So one of the most technical and demanding requirement in IFRS S2, we will walk through the how select appropriate of climate scenarios, and we will see that how it's work on the particular sides of those kind of stuff. So before that, I just wanted to announcement of the very brand new stuff that I'm going to launch. And on the 17th March, on Tuesday, we are going to have a session on the cloud code for climate risk and ESG reporting. So if you want to make sure that you are very much ahead in the cow of AI, then you should register for this particular webinar. It's free to attend, and I'm going to show you that how Cloud Code help you or AI help you to do your day-to-day life analysis of climate risk and ESG reporting. So go and register to this particular link that I have already shared in the chat box, and we will have the detailed analysis of climate things on 17th March. So you can go and register yourself before filling very fast. So it's a free right now, and it is going to be just for my subscribers and followers. So that is why I'm just sharing this link here. So go and check and register that how Cloud Code generative AI is helping for the calculating the climate risk and the ESG reporting. So here we already have a good amount of understanding of IRO, and we have a great time to understand of end-to-end ESG reporting series. So if you have any questions, drop them in the comment. If you found this valuable, please share it with your colleague. Please like so that we can develop this kind of content and get some motivations on that side. So this kind of knowledge needs a spread through finance and sustainability team so as quickly as possible. So please share those kind of stuff. So thank you so much for making it through this IRO. This is genuinely one of the most important modules in this series, and I will see you in module 11. Thank you very much.